Hello everyone, welcome here to the Liquidity Mining Portfolio Optimizer. Sounds a bit complicated, but it's not too difficult to understand and it will provide a lot of value to you. From the last video about liquidity mining pairs from dashboard 5, you know that the risk matters for your liquidity mining. You know about the returns over a 1 year time horizon. And you also see by the help of the Sharpe ratio which liquidity pair paid the highest return per percentage point of risk. Now it's a question, do we just choose the liquidity mining pair that has the biggest Sharpe ratio and invest everything into it? Or do we diversify? And generally in finance, whether stocks, real estates, whatever it is we do invest in, we should always diversify. But now we help you in this dashboard to find out how much do I invest in which liquidity pair to maximize my return by keeping the risk constant, or vice versa. This is what coming soon. You choose the amount of return and we minimize the risk. All of this is based on a min variance portfolio and is widely used by hedge fund managers that select stocks, by ETFs and other big financial companies that try to diversify their risk and generally try to reduce it. Let's have a look into the dashboard. So at the moment you see here 5,000 different portfolios. You can click each of those points. How to interpret them? Let's consider one level of risk. Risk is standard deviation. We just made it in relative terms here in percentage, so it's easier to display it and easier to understand it. When we look at this point, for example, here at 75% of risk, we see the allocation is, or first of all, after the risk, we see the return, 968% per year. If we invested, this is based on historical data, if we invested 3.8% into the Bitcoin DeFi liquidity mining pair, 1% in the liquidity mining pair for Ethereum and DeFi, 20% in the Tether US dollar, and so on and so on. You see the rest of the allocation of that portfolio. So here comes the interesting thing. At the same level of risk, we can go up here. So we're still on 75, and you see this one point here. We're still at 75% of risk, but now we have a return that is 1049%. So it's about, I think, how much was it here at the bottom? 968. So let's assume more or less, a bit less, but almost 100% more return by just changing the allocation of the portfolio, because the overall risk is the same, but the return is bigger. Usually in standard traditional finance, we choose a return and reduce the risk. So we could show you the same thing when we are here at the return and we go down in this direction, just on the 1049 mark, and just see you can have higher risks for the same return. This is how we want to display it to you soon, that we change the axes so that it becomes more clear that you choose a return and we minimize the risk for you. Good. So all of this comes from correlation coefficients, from how does the different coins move together, and is based on the portfolio min variance theory. Just to give you an example down here, when we choose the return of 1015%, we've plugged you a few different portfolios here, and you see that one portfolio, the best one, has a Sharpe ratio of 14.6 for this return this amount of risk, and if we go to the really bottom, we see the return always stays constant, but the risk is almost 30% bigger. So the Sharpe ratio is way lower. So why would you choose this allocation of the portfolio if it has the same return but a higher risk? And to show you the difference of the best and the worst portfolio, we displayed you here the best portfolio for this amount of return and the worst. So what's going to come here soon? Soon in this dashboard, we let you choose which coins for liquidity mining you select and which will be included into the portfolio. So you can say, I need to have this included, or you can just say, this one, this liquidity mining pairs I would be investing in, but the mass and the machine should tell me what is the best allocation. Then we change return and risk, so we let you choose the return and then minimize the risk, such as here shown. And now we have some more special things that will come up soon that we'll show you once it's released. We can also go a bit more into detail about the math behind this to better understand why it's so sensible to diversify also when providing liquidity mining. If you wish to have that, just comment it into the video. Then once we do the final release for the liquidity mining portfolio optimizer, we will include this into the video. Good. I think this will provide a lot of value to you. Thank you very much. Bye bye.